If I told you that you can make a full-time income trading stocks in only a few hours of your time per week and without taking on a large amount of risk, you probably wouldn't believe me. And I definitely don't blame you, but today we're gonna talk about how to do exactly that. So let's get into it. My name is Charlie, and on this channel I talk about wealth building and achieving financial freedom so that you can free up your time to focus on the things that you truly care about. So the stock market strategy that I'm talking about today is covered call writing, otherwise known simply as selling covered calls. And I was pretty skeptical too when I first learned about the potential of this strategy, but it really does work. So to understand covered calls, the analogy that I always use is that it's basically the stock market equivalent of buying a real estate property and renting it out to someone. And I mean that in the sense that once you own shares of a particular stock, you can then use those shares to generate income on a regular basis. So in stock market terms, what you're actually doing when you sell a covered call is selling the rights to someone else to buy your stock away from you if it hits a certain price by a certain date. And when you sell those rights, you get to collect a small amount of money, which is known as a premium, and you get to keep that premium regardless of what happens to the share price after that call is sold. So to better understand how this works, let's jump into Yahoo Finance to look at some examples of how this would actually play out in the market right now. Now the first thing you should know is that call options are bought and sold in 100 share increments, meaning that you have to own at least 100 shares of a stock before you can sell a covered call against it. So obviously because of that, you should only sell covered calls on stocks of companies you believe in. So we're going to look at Apple here, which has pulled back a bit over the last week or two, as you can see, but generally it's a pretty stable stock. It's a member of the Dow Jones Industrial Average, it pays a dividend, and after its recent 4-to-1 stock split, it's at a great price for covered call writing, so it's one of the main stocks that I'm personally trading right now. And as of September 14th, 2020, when I'm filming this, it's trading at $112, so in order to buy 100 shares, you'll need to put out an initial investment of $11,200. Now let's head over to the options chain here, which you can look at on Yahoo Finance by clicking options. And from there, you have two decisions to make when deciding which call you want to sell: the strike price and the expiration date. The strike price is the price at which you'll have to sell your shares if they're above that price by the time the call expires, and that's represented by this column here. And the expiration date is of course the date that the call actually expires. So the expiration date is listed up here. Right now we're looking at an expiration of Friday, September 18th, which is about 5 trading days out, but you could choose whichever expiration date you like. Calls always expire once per week on Fridays, so that's why each of these expiration dates listed are Fridays. But for today, we're going to look at this September 18th expiration. Now this column right here shows the premiums, which is how much money you would bring in for selling a call at each specified strike price. Now generally I sell calls at anywhere from at the money, meaning where the strike price is equal to the current stock price, to about $5 out of the money, meaning that the strike price is about $5 higher than the current strike price. So since Apple is currently trading at $112, the closest we can get to the at the money strike is this $112.50 strike, and about $5 out of the money would be this $117.50 strike. So you can see that the further out of the money you sell the calls, the lower your premium will be, but in that case you'll also have a higher potential for bringing in additional capital gains if the stock rises before the expiration date. Now as far as expiration dates, the farther out in time you go, you'll also bring in larger premiums. So you can see that at the money strike 2 weeks out brings you a premium of $4.15, whereas the at the money premium 1 week out brings you a premium of $3.05. But the further out in time you sell your calls, the higher potential you have to miss out on potential capital gains if that stock rises, so most of the time I prefer to sell my calls 1 to 2 weeks out in time. And again, for this example, we'll be looking at the calls for Apple that are about 1 week out. So we've bought our 100 shares of Apple for an initial investment of $11,200, and now let's say we want to sell a call about $3 out of the money with an expiration date 1 week out of September 18th, 2020. So to find that $3 out of the money strike, we're looking around $115, which is right here. So the premium we bring in will be $2 times 100 shares, because remember that these are all done in 100 share increments. So the total premium comes out to $200. Not bad for a 1 week call. But let's do some actual math now to figure out what our potential gains are here. And there's two scenarios that could happen. Either the stock hits or exceeds the strike price by the end of the day on September 18th, or it doesn't. If it exceeds the strike price, you sell the shares at that strike price of $115, so your capital gains come out to $300, in addition to the initial $200 premium that you brought in. If the stock doesn't hit the strike price by the end of the day on September 18th, nothing happens, so the call expires and you keep your premium and you keep the shares. So your total realized gains are just the initial premium, which was $200, and you can go ahead and sell another call the following week in the same way. Now the size of that premium that you bring in next week will depend on what actually happened with the stock. So for example, in a worst case scenario, if the stock does drop, say it hits about $105 within this week, you're going to be bringing in a much smaller premium next week because you'll have to sell it further out of the money in order to avoid the risk of selling your shares at a loss. But that's a pretty unlikely scenario, and that's the reason that you want to sell calls on stable stocks that you believe in for the long term, so that you minimize your chances of that happening. But if the stock price stays the exact same over the course of that week, you can just sell another call $3 out of the money and bring in approximately that same $200 premium that we did this week. So you can start to see how powerful these covered calls are, because even if the stock doesn't move at all, you could bring in $200 or more per week just by owning a stable stock like Apple. So let's start to look at the percentage returns based on those two scenarios that we discussed, so you can really see how powerful these covered calls are. So for the sake of this example, we'll assume a month is about 4 weeks. And in the case that the stock doesn't move and you bring in that $200 premium each week, that's $800 over the course of a month. From that initial investment of $11,200, which is a 7% return over the course of 1 month. Now in the case that the stock rises $3 per week and you're selling those $3 out of the money calls, which is a pretty unlikely scenario, but it can definitely happen in a very strong stock. You bring in those $300 capital gains per week, plus the $200 premium, which is $500, times 4 weeks. That's $2,000 over a 1 month period for that initial investment of $11,200, which comes out to 17.8% returns over the course of a month. And again, that's highly unlikely, but it's just to demonstrate the maximum potential of this technique. Now let's compare that to if you had just bought 100 shares of Apple and held on to them, which is what most investors would probably do. If that stock doesn't move over the course of a month, you're not bringing in any income, and the value of your stock doesn't change at all. Whereas if you're selling these covered calls, even if the stock doesn't move, you can bring in $200 per week, which is a 7% return per month on this stock, which is pretty unheard of using any other technique that's as low risk as this one. Now, Apple does have pretty good premiums because even for a stable stock, it's relatively volatile. So let's look at one more quick example, which is Nike. Nike is currently trading at exactly $118, so in order to buy 100 shares of the stock, we'll need to put out an initial investment of $11,800. Then let's say we want to sell the strike just $1 out of the money because we don't think it's going to move very much. You'd bring in a premium of $138 for that 1 week period. So getting out our calculator, $138 times 4 weeks for an initial investment of $11,800. Gives us a 4.6% return over the course of a month, even if the stock doesn't move at all. Then factoring in capital gains, we could bring in a maximum potential of $138 plus $100 in capital gains because we sold at the strike price that's $1 out of the money, times 4 weeks, divided by that initial investment of $11,800. Our maximum potential returns are 8% for a 1 month period of performing this trade. So if you're bringing in 4 to 8% per month just by owning a stable stock like Nike, which again is in the Dow Jones Industrial Average and pays a dividend, that's a pretty hard strategy to beat. Now, of course, I can't talk about the strategy without covering the downsides, and in my opinion, there aren't that many, but the main thing is just that you miss out on those potential capital gains if a stock that you're selling covered calls on does happen to rise rapidly after you sell that call. So for example, with Nike, if we again sold that $1 out of the money strike, brought in a premium of $138, then the price of Nike hit, say, $125 over the course of that next week, we missed out on some potential gains of about $600 because we're going to have to sell the shares at $119 at the end of the week, where if we hadn't sold a covered call, our shares would be worth $125. But for me, that trade-off is well worth it because when you bring in that premium, you're bringing in guaranteed income, whereas when the value of the stock rises, you don't actually earn that money until you actually sell the shares. And there's always the potential that you just hold on to those shares thinking that they're going to keep rising, and then they quickly crash back down and all of your quote-unquote gains that you would have brought in disappear instantly. But when you're selling covered calls, those premiums that you bring in never go away. And that's why this strategy, in my opinion, is the absolute best way to bring in consistent income and achieve financial freedom using the stock market. Of course, the other disadvantage of covered calls is that you do have to have a good amount of capital up front to invest, but that's also something that can be built over time. So even if you have to start out selling covered calls on just 1 or 2 stocks at a time, you can quickly grow your account to sell more and more sets of covered calls and bring in more and more income each month. So you might be wondering, if this strategy seems so foolproof, why doesn't everybody do this? And that's a pretty loaded question, which I plan to go further in depth on in future videos, but I think it really just comes down to a general lack of education about finance and about the stock market, combined with people's tendencies toward instant gratification rather than being patient and realizing that wealth building takes time. So now that you know the basics of covered call writing, be sure to subscribe to my channel to stay updated on all of my future videos, where I'll go much further in depth on this topic, in addition to lots of other financial freedom related content. So there you go. I'll see you all in the next one.